For over 50 years, Japan has been America's most loyal financial partner. While China gets all the headlines, Japan quietly holds over $1.18 trillion in U.S. Treasury securities, making them the largest foreign holder of American debt. That's more than China, more than the UK, more than any other nation on Earth. But here's what makes Japan truly dangerous to the dollar system. They're not just holding our debt. For decades, Japanese investors have been borrowing yen at near zero interest rates and are using that cheap money to flood into American assets, stocks, bonds, real estate. This is called the yen carry trade, and conservative estimates put its size at hundreds of billions of dollars, with broader yen-funded exposure in the low trillions. Think about that for a second. Trillions of dollars of liquidity propping up American asset prices, all funded by borrowing in a currency that's been essentially free for 2 decades. This arrangement has been the secret engine of American prosperity. It kept our interest rates low, it kept our stock market inflated, it allowed us to run massive deficits without consequence. Japan wasn't just buying our debt, they were subsidizing the entire American way of life. But that era just ended. On December 1st, 2025, Bank of Japan, Governor Kazuo Ueda stood before business leaders in Nagoya and said something that sent shockwaves through global markets. He announced that the Bank of Japan would consider the pros and cons of raising the policy interest rate at their December 18th to 19 meeting. Within hours, markets went haywire. The probability of a rate hike jumped from 58% to 76% overnight. Japanese government bond yields surged to their highest level since 2008. The yen strengthened dramatically, and global investors began to panic. Why? Because after maintaining negative interest rates for nearly a decade, Japan is finally tightening monetary policy. And when Japan tightens, the entire global financial system feels it. Current intelligence suggests the Bank of Japan is ready to raise rates from 0.5% to 0.75% this month, and that's just the beginning. Bank of America is now forecasting the terminal rate will reach 1.5% by the end of 2027, with additional hikes coming in June 2026, January 2027, and July 2027. This might not sound like much, but in a world where Japan has had zero or negative rates for over 20 years, even small moves create massive ripples. Here's where it gets truly dangerous. Remember that yen carry trade I mentioned? For years, investors could borrow yen at essentially 0% and invest in U.S. assets yielding 4%, 5%, even 10% or more. It was free money, a money printer, the easiest trade in finance. But now, as Japanese rates rise and the yen strengthens, the trade is reversing. And it's not reversing slowly. It's unwinding with the force of a tsunami. When the carry trade unwinds, here's what happens. Investors must sell their U.S. stocks, bonds, and other dollar-denominated assets, convert those dollars back into yen, and repay their loans. This creates massive selling pressure on American assets and on the dollar itself. We've already seen this movie before. In August 2024, when the Bank of Japan made its first surprise rate hike, the NASDAQ 100 fell 13% in less than a month. The yen surged 14% against the dollar. Global markets went into freefall, and that was just from one small rate increase. Now multiply that by several rate hikes over the next 2 years. The potential for chaos is enormous, but it gets worse. While the carry trade unwinds, something else is happening that should terrify every American. Japan has been quietly selling U.S. Treasury bonds. In the third quarter of 2024 alone, Japanese investors sold a record-breaking $61.9 billion in U.S. Treasury securities. That was the largest quarterly sell-off ever recorded from Japan. And the selling continued into early 2025. According to data from J.P. Morgan, Japanese investors have been particularly aggressive in dumping long-dated treasuries. From the start of 2025 through April, they sold approximately $227 billion worth of U.S. government bonds. Now, Treasury officials and mainstream economists will tell you this is no big deal. They'll say the Treasury market is enormous, that $200 billion is a drop in the bucket. But they're lying to you. Here's what they won't tell you. It's not just about the absolute numbers. It's about momentum. It's about psychology. When the world's largest holder of your debt starts selling aggressively, other investors notice. They start asking questions. They start demanding higher yields to compensate for the risk. And that's exactly what we're seeing. After Trump announced his aggressive tariff policies in April 2025, yields on 10-year U.S. Treasury bonds spiked to 4.92%, the largest weekly increase since 2001. The panic in the bond market spilled over into stocks, causing the S&P 500 to plunge 12% in just 4 trading days. Who was doing the selling? According to analysts, most of it was coming from Japan. Now you might be wondering, why is Japan doing this? Why would they destabilize their closest ally? The answer is simple. They have no choice. For years, Japan has been trapped. Their economy has stagnated. Their population is aging and shrinking. They've tried everything: negative interest rates, unlimited quantitative easing, direct market interventions, and nothing has worked to generate sustainable growth. Meanwhile, their currency has been crushed. At one point in 2024, the yen hit 161 to the dollar, the weakest level since 1986. This decimated the purchasing power of Japanese citizens, making imports ruinously expensive and fueling inflation that the country hadn't seen in decades. Japanese pensioners who invested their life savings expecting stability watched helplessly as their nest eggs were devalued. The political pressure became unbearable. The government had to act. But here's the cruel irony. The very thing that kept the yen weak was Japan's financial support of America. As long as they kept buying our debt and keeping their rates at zero, the yen would stay weak and their economy would suffer. So now they're trapped between two impossible choices: continue sacrificing their own economy to support the dollar, or pull back and risk destabilizing the global financial system. They have chosen their own survival, and that means America is on its own. But the yen, carry trade, and treasury sales are just part of the story. There are three massive forces converging right now that are all threatening the dollar simultaneously. First, you have the Bank of Japan's rate hikes unwinding trillions in yen-funded positions across global markets. Second, you have Japan pulling back from treasury purchases and even actively selling, reducing demand for U.S. debt just as our deficits are exploding to $2 trillion annually. Third, and this is the one that nobody's talking about, you have the broader de-dollarization movement gaining unstoppable momentum. BRICS nations are accelerating their efforts to trade in local currencies. They're building alternative payment systems like BRICS Pay to bypass SWIFT. They're accumulating gold reserves at record pace. In 2024 alone, central banks added 1,045 metric tons of gold, the third consecutive year above 1,000 tons. China and Russia now conduct over 90% of their bilateral trade in yuan and rubles. India has signed agreements to trade in local currencies with the UAE, Indonesia, and numerous other nations. Even Saudi Arabia, despite fake news about a petrodollar agreement, is openly discussing pricing oil in multiple currencies, including yuan, euros, and yen. The dollar's share of global reserves has declined from 85% in the 1970s to just 58% today, and that decline is accelerating. Now, de-dollarization skeptics will point out, correctly, that there's no unified BRICS currency coming anytime soon. India has made it clear they oppose this idea. The internal contradictions within BRICS are real, but here's what they are missing. You do not need a BRICS currency to undermine the dollar. You just need the momentum away from dollar dependence to reach a tipping point. And we're approaching that point right now. This brings us to America's nightmare scenario, a scenario that's unfolding in real time. The Federal Reserve is caught in an impossible trap. If they cut rates too aggressively to support the economy, the dollar weakens, foreign investors dump U.S. assets, and the selling pressure becomes self-reinforcing. We saw a preview of this in August 2024. But if they keep rates high to defend the dollar, they risk crushing the American economy. Higher rates mean more expensive mortgages, more expensive car loans, more expensive business borrowing. It means the banking system comes under stress. It means the national deficit becomes even more unsustainable. And remember, all of this is happening while the U.S. government is running $2 trillion deficits. We need foreign buyers to finance these deficits. We need Japan and other countries to keep buying our debt. But they're not buying anymore. They're selling. According to Wellington management analysts, this foreign ownership constraint means the Fed cannot ease as much as markets are currently pricing, even if growth decelerates. They're trapped. Damned if they do, damned if they don't. Which brings us back to December 19th, 2025. Less than 2 weeks away. If the Bank of Japan raises rates as expected, several things will happen simultaneously. One, the interest rate differential between U.S. and Japanese bonds will narrow further, making the carry trade even less attractive and accelerating the unwind. 2, the yen will likely strengthen significantly, forcing even more liquidation of dollar positions as hedging costs spike. 3, Japanese government bond yields will continue their surge, creating competitive pressure on U.S. Treasury yields and potentially triggering another wave of selling. 4, the repatriation of capital back to Japan will accelerate as domestic yields become attractive for the first time in decades. Japanese banks, pension funds, and insurance companies hold trillions in foreign assets. Even a modest repatriation flow could be devastating, and this is just the immediate impact. The longer-term implications are even more troubling. As one risk analyst put it, the Bretton Woods 3 scenario, a new global financial order centered around commodity-backed currencies and reduced dollar dominance, is becoming increasingly plausible. Think about the 3 pillars that have supported dollar hegemony for the past 50 years. Pillar 1, the petrodollar system, where oil is priced in dollars, and oil exporters recycle those dollars into U.S. assets. This pillar is weakening as major exporters diversify into other currencies. Pillar 2. The willingness of allies like Japan to finance U.S. deficits by holding massive treasury positions. This pillar is cracking as Japan prioritizes its own economic survival. Pillar 3. The yen carry trade and other forms of foreign capital that flood into U.S. markets seeking yield. This pillar is actively unwinding right now. When all three pillars weaken simultaneously, which is exactly what's happening, the entire structure becomes unstable. So what does this mean for you? What should you expect in 2025 and beyond? In the near term, watch for extreme volatility. The December 19th Bank of Japan decision will be critical. If they hike rates and signal more hikes to come, expect markets to react violently. We could see stock sell-offs, bond market turmoil, and sharp movements in currency markets. But the real danger isn't the next few weeks, it's the next few years. As Japan continues normalizing monetary policy and the carry trade continues unwinding, the U.S. will face persistent downward pressure on asset prices and upward pressure on borrowing costs. This will make it harder to finance our deficits. It will make it harder to maintain our standard of living. It will expose the structural weaknesses in our economy that have been masked by cheap foreign capital for decades. And here's the thing that keeps me up at night. Once this process starts, it's very hard to stop. Foreign capital flows are like water. Once the dam breaks, the flood is inevitable. And right now, we're watching the cracks spread through the dam in real time. The American economic empire was built on three things: the petrodollar, treasury demand from allies, and yen carry trade liquidity. One by one, these supports are being pulled away. And when the last one falls, the entire structure will need to be reimagined. This is why you won't see this story on mainstream financial news. This is why the pundits are still telling you everything is fine. Because once people understand what's really happening, once they understand that the foundation of American prosperity is eroding in real time, panic becomes inevitable. And panic is exactly what the system cannot afford right now. But you need to understand this isn't about doom and gloom. This isn't about predicting the end of the world. This is about understanding the real risks you face so you can prepare accordingly. The dollar won't disappear overnight. American power won't evaporate in a day. But the world is changing, and the assumptions that have held for 50 years are no longer valid. Japan just fired the opening salvo in what could be the greatest challenge to dollar hegemony in modern history. And on December 19th, we'll find out if this is just a warning shot or the beginning of the end. The dollar's biggest test has begun. And this time, there's no bailout coming from Tokyo. Stay vigilant, stay informed, and whatever you do, don't believe the lies they're telling you about how everything is under control. Because if everything was under control, Japan wouldn't be making these moves, and the Bank of Japan wouldn't be preparing to pull the trigger